Ninth Global Family Office Investment Summit here in Monaco, hosted by the Ritossa Family Office. Here with me, another distinguished interview from this gathering. We have Nick Eskandari from Keybridge Fund. Sir, very good to have you here. Thank you.
Thank you for having me.
First of all, I would like to start off this interview by asking you, why have you decided to come all the way from the United States, from California, where you are based, to Monaco?
Well, this summit creates a forum to hear from a group of highly successful family offices as to their investment strategies and interests. And that's been a very interesting experience for us.
Now, what is Keybridge about? What is your fund about? What are your investments? Which field of expertise is yours?
So basically what Keybridge Capital, or Keybridge Fund, basically there are two companies. One is the lender and the other one is the management company. Does only one thing, which provides capital to real estate developers, investors. No more than in 2019, 50% of the value of the property that we lend on in prime locations, I want to say, mostly in California, coastal areas, if you will, from San Francisco to San Diego is really where our primary market is. Real estate is a very local business.
So you provide capital to real estate developers.
Correct.
And what is your viewpoint on the health of the real estate market right now? Let's stick to California, which I think you know better than the whole country. But
correct.
Real estate market is always a gauge, a sort of matrix for where the economy in the United States is going. What is your viewpoint?
Well, my viewpoint, the general viewpoint is, it's basically like any other business, it's the supply and demand. Another factor is affordability. One of the things that concerns me, based on my, I want to say 30 years of experience in real estate lending, is that a lot of the people that we know live in good locations of California cannot afford to buy their home in good markets, if you will, let's say, the coastal areas. So that's a concern. People are pushed way back to more inland areas to buy a smaller home in terms of affordability. In terms of where we are in the cycle, I believe that we are probably at the end of this long bull run that we've had and experienced in the US. So we've been very conservative this year in terms of our valuation on loan to value.
You have lowered your loan to value, right?
We have lowered our loan to value from 60% last year, again, case by case, location by location, to no more than 50%. We are a bridge lender. The name of the company is called Keybridge Capital. And by that is that we provide short-term loans for these real estate developers. And what makes us different is really speed. What we look into when we start underwriting a loan request is the very first thing is the value of the property. And the way we determine value is by its location. In today's technology, that process usually takes much faster than traditional appraisers used to look into and provide the 30 or 40 page report. And to be honest with you, sometimes those reports are not very much dependable. I sometimes jokingly say to these appraisers, go ahead, or developers that actually provide those traditional appraisal reports. Sometimes make a joke and I say, I'll bet you won't even be able to sell that property 90% of the appraised value that you're giving me. So value to us is very much different than brokers, owners, and developers. And by that I mean, we're not emotional, we're lenders. They say one way to understand real estate value is from a lender's perspective. I don't want to use the word conservative, but I think we're more realistic when it comes to value. So that's the very first thing. The second thing is exit strategy. When are we going to get our money back? So we'd like to enter into every loan transaction by exit, at least being able to see exit. Most of our clients, I want to say 90% of the majority of our borrowers are very high net worth. In 2008, when the market crashed, banks really shifted from a reckless lending, if you will, that created that crash in 2008, to very conservative lending guidelines. Basically, these two senators, as you probably know, Senator Dott and Senator Frank, put a financial brake on the financial system, including banks. And that created a huge market for us. So speed matters to developers and and owners and sponsors, and certainty. And that's why they come to a company like us. Our rates are probably the most competitive rates in US when it comes to private capital. And the certainty of execution is very important for these people. We could literally close the deal in 10 days once we're absolutely confident about the value we're lending against, the location of the property, and obviously experience of the sponsor is very important to us.
You have partially already answered to my following question, but how do you manage not to get caught up in the frenzy of lending, given that the area you insist on, California, is literally booming? You mentioned there are people who can't afford with a good job to stay in San Francisco or in the Bay Area, for instance.
That's a very good question. We typically don't lend against the single family residence. So our typical clients are commercial real estate owners, office buildings, apartment buildings. More people now live in apartments and rent than buy. Even people that are becoming doctors and lawyers, they are renting. The demand for rent is high. And how do we even manage that aspect of our business is a very good question. Not to get really caught up with this lending and just go on and on. I can tell you that this year we've declined more loan requests than we did last year. So we're conservative in our underwriting guidelines.
You mentioned also what happened after the 2008 and what happened with the Dodd-Frank Act, but now part of it has been repealed. Do you see the same conservative approach in lending by banks, or do you think we are heading towards another situation where the housing market, probably not the high end of it, which is your field of expertise, could crash again?
Well, the high-end real estate, residential market, by that meaning single-family residence, we're shying away from it this year. We're not lending against those expensive homes that we did 2 years ago, let's say, or even last year in prime locations. California is a very prime, certain parts of it, location in the world. I mean, homes are sold between 20,000 square feet, between 1,000 to sometimes 2,000 and 3,000 square foot. We use square foot in the US, you use square meter here. So I think a 10,000 square foot home is equivalent to 1,000 square meter here. This year we're not lending on those properties because we see that those homes stay in the market much longer before they're sold, and owners are going to have to cut prices. So we're seeing the downward pressures on that market. That's really not our typical market, but there's definitely, we are seeing some corrections on high-end homes. We're seeing it. New York, for example, we get a lot of requests from New York. I think that some of the property values have gone down. I don't know exactly by how much. That's really not our primary market. But in California, developers that were expecting a much higher number on their investment are painfully realizing that their calculation was wrong, and that they would get a lot less than what they anticipated. So we're seeing corrections already, and I think correction is very healthy for the economy. We like that correction. I think it's overdue, but I don't see a recession. This cycle is definitely not like 2008. The leverage, which is really the number one recipe, high leverage, for a correction is not in Los Angeles. People have a lot of equity in whatever holdings they have. We've never had an economy, or at least I don't remember that we've ever had an economy where interest rates are super low or historically low. Unemployment is 3.6%, meaning everybody that wants to have a job has a job. And also inflation is tamed. So all of those three recipes is really helping consumers' confidence. And that's what's contributing to the health of the economy. That's why we don't think they're going to raise interest rates. In fact, the Federal Reserve lowered their expectations from raising interest rates to not even lowering interest rate. And also, we don't see a recession in this year for sure. And in 2020, I don't think, maybe by the fourth quarter, we're going to see more pressure, downward pressure. But in terms of a real recession that what we experienced, I don't think anybody's expecting that, at least in the United States.
Lastly,
anytime soon, at least.
A huge component of the upward pressure in the housing market in the U.S. was the purchasing power by foreigners.
Correct.
Especially not Europeans, Chinese, wealthy Indians. They flock to California, they flock to Vancouver or Toronto in Canada. Do you still see this influx of capital from such countries, or due to the trade war, due to the ongoing commercial tensions, this influx of money has subsided, and now there is a sort of pause in this money that has been pumped into the system?
Well, there's definitely has been a pause, especially from China. Money is not coming the way it was coming and flowing into the United States real estate market in 2015 and 14, maybe 16. That's not happening anymore. We are looking at a lot of developments that Chinese community got involved in 2015 and 2016, and they thought that they could get the rest of the capital to complete the project, and that's not happening. They're coming to us to bail them out. So we're seeing that, and the answer is yes, absolutely. And not only that, you've got a lot of, you can stop anytime you want.
No, go ahead.
And not only that, smart money calculates and figures all these situations where if you're at the top of the market, you're more conservative in investing. I have personally always been against anybody who wanted to pay $40 million for a single-family residence. In my personal opinion, even though our office is at prime, in Beverly Hills for the past 30 years, so a lot of our clients are very high net worth, but people generally who can afford the 30 or 40 or $50 million home are in their 50s and 60s, and maybe one person or two people. And why would they want to live in a 20,000 square? It just didn't make any sense, and I really didn't want to be a part of it. So we don't finance those projects. That market is changing for sure. It's about being efficient, and efficiency is the name of the game. I think the market where people actually need to buy, which is much smaller homes, that market stays strong. The high-end homes obviously are not staying strong. There's definitely an adjustment. We see those adjustments. In terms of commercial real estate value, that is also a little bubble. And that bubble we see is that in rents, income, or when you see these real estate developers building these units and apartment buildings, and some analysts, without having really any previous experience, pencil in a very high rent, where in turn generates a value for that property upon completion. We say when the rubber hits the road, it's a different world. After the property is completed, they're realizing they can't get the same rate or rent that they were projecting. Right. So that's putting a pressure on downward pressure on value. So as a result, our value, 50% no more, close a transaction, be able to see an exit. A lender, an exit is they either stabilize the property, sell the property, or refinance the property, or they have to put up more money into the property in order to take us out.
Well, thank you for this interesting conversation. I think some of the rules or consideration you have just mentioned applies also to Monaco, which is the hottest real estate market in Europe. Thank you to Nick Eskandari from Keybridge Fund. Sir, it's been a pleasure to have you here. Thank you again.
My pleasure, and thank you very much.
And that's it, but we will have more interviews from this 9th Global Family Office Investment Summit hosted by the Ritossa Family Office. So do stay with us.